Hello and welcome back to Module 5, where we're still talking about deciding what shares to buy. And in this topic, we're looking at what to do with the numbers, making sense of the numbers. So let's get started. So we look at the numbers from financial statements to help us answer two questions. Firstly, what am I buying? And secondly, how much am I paying for it? So looking at financial statements, you'd want to look at 5 things as a start. So sales, profit, debt, equity, and dividends. So sales and profit, where do you find that information? On the income statement. And what would you typically look for? You'd look for patterns of growth. So have the sales of the company been growing every year? And in terms of a rough estimate, you'd probably be looking for between 5 and 10% growth. But that's not a hard and fast rule. And then debt and equity, those figures you get from the balance sheet of the company. And that will tell you about the company's debt to equity ratio. So a little later on, we're going to talk about the debt equity ratio, what it tells you, and how to calculate it. And then also the dividends of the company, because obviously when you buy shares, what you get as an investor, apart from capital growth, is the dividends. And you get information about the dividends from the company's results. And as an investor in shares, you'd be interested in the dividend yield. So we're going to talk a bit more about dividend yield and how to calculate it later on in the same topic. So if we look at the debt and equity, as we said, it's from the balance sheet. And from that, we'd look at the debt to equity ratio. And what does that tell us? That's basically when you take the total debt of the company divided by its total equity, because you want to make an assessment of how much debt a company has relative to its equity. Because remember, debt needs to be paid back to borrowers. So if a company has a debt to equity ratio of less than 1, that's favorable. And usually if it's greater than 1, it can be cause for concern. But it's not a hard and fast rule, because there are different nuances in different industries. So you actually need to compare with industry averages to see if the debt equity ratio of a particular company is in line with other companies in the similar line of business within the same industry. So for example, if we look at a debt to equity ratio of 5, that would tell us that for every 1 rand of equity a company has, they've got 5 rands worth of debt. And you know, that could be cause for concern, because it could mean that the company is too indebted. But like I said, always compare with the company averages. And let's move to the next one, dividends. So dividends, you look at your dividend yield, and that is basically calculated as the annual dividend per share divided by the price per share. So that basically tells you that, fine, if I spend 50 Rand buying a share and I get a 10 Rand dividend, I'm getting 10 out of 50 Rand as a return in the form of dividends. So what you'd look for as an investor is a company with an increasing dividend yield while the share price increases, because if the share price increases but dividends stay the same, then the dividend yield is actually going to decrease. But if you have a situation of an increasing dividend yield while the share price drops, it's not a good sign. And typically investors look for companies where shares tend to increase, because it's seen as positive, whereas a decreasing dividend over time is viewed negatively. And the problem with that is that if there's negative sentiment around a share, investors tend to sell, and then you could see the price of the share drop in the future. But once again, if you're looking at dividend yield, you'd want to compare the share that you're looking at to the industry averages to see how it fares against other competitors within the same industry. And then if we look at profit or net income, that you get from the income statement, and then equity you get from the balance sheet. And when you combine those two figures, you can actually calculate a company's return on equity. And return on equity is simply the net income divided by the equity. So if you look at a company and they've got a return on equity that's greater than 15%, that's usually a good sign. But once again, always compare the company to the industry averages. So we've looked at what am I buying. Now we're looking at how much am I paying for it. Let's start off with price versus value. So it's not a good idea to make a decision on shares based simply on price. So if we take a simple and silly example and think of buying apples. If I show you a price tag and I say one apple costs 8 Rand and the other one costs 1 Rand, if you were basing your decision purely on price and not the value for your money, you might be inclined to go with the 1 Rand apple. But if I had to show you a picture to show you what you were buying, you might actually shift and think that, you know, the 8 Rand apple is now giving you value for money. So we can apply the same thinking to shares. So we're going to look at a new word or new term, market capitalization. And market capitalization is basically the number of shares that a company has in the entire market multiplied by the actual share price. And then the net asset value. So net asset value is actually the net worth of the company, which is simply its equity. So I'm introducing different words just to get you familiar with the financial market jargon, because you will definitely come across it as you go along. So when you look at market capitalization and net asset value, what you want to look at is which is greater. If market capitalization is greater than equity, what does that tell us? It tells us that the share that you're buying might be overvalued, which means that it's probably not good value for money. It's overpriced. And if your market capitalization is less than equity, that tells you that this particular share that you're looking at might actually be undervalued, which means that it's probably good value for money. And then there's earnings per share. Earnings per share, some people would argue, is one of the single most important things to look at because it actually gives you a sense of how profitable a company is. And that basically tells you how much of the company's profits goes to shareholders. So whenever you're buying shares or comparing companies and trying to decide what share to buy, generally people tend to look for companies with the greater earnings per share. And then you've got the price to earnings ratio, which is simply known as the PE ratio. And that gives you a sense of whether or not you are paying too much for a share. So we're going to look at these in more detail and also showing you how to calculate them. And that will be done in Module 5, Topic 4, where we basically put all of this information together in looking at how to decide which shares to buy.